Welcome back. This video will cover receivables, both accounting for delinquent accounts or bad debts and interest-bearing notes. Think back to the basic entry for a credit sale. We debit accounts receivable and credit our revenue account. The idea is that we've earned the money but not yet received it. We have a right to receive it in the future. That's the significance of accounts receivable. Note that in this video, I'll refer to the AR accounts of specific customers who will be referenced in the account title as seen here. By the very nature of credit sales and accounts receivable, it's a given that some of the credit customers will not be able to pay. There are a number of reasons this might happen, but most commonly, the economy or the business's industry enters a recession, and the company in question starts experiencing net losses and cash flow problems. Common indicators that a particular customer's AR account may be delinquent include the same reasons a friend or a family member probably won't repay money he or she owes you. Specifically, the company's employees stop answering the phone or returning calls. Now, you might be able to make contact using email, but getting a live person on the line is impossible. If you're dealing with a small local operation and the company moves without informing its vendors, that also doesn't bode well for getting your money. Obviously, if the company files for bankruptcy, you probably won't get paid, though as a creditor, you do take priority in the company's asset liquidations over the owners. Most significantly, once the AR is past due, you need to start paying attention to it. The longer an account receivable is past due, the less likely it will get paid at all. How do we account for any delinquent accounts, also known as bad debts? Well, we have two methods. The simple, easy, straightforward direct write-off method and the slightly more in-depth allowance method. Working with a $1,000 AR balance, if the customer notifies us that he or she won't be able to pay, under the direct write-off method, we remove the balance with the following journal entry. Since the AR will no longer be collected, we'll credit accounts receivable off the books. This reduces the AR balance to zero. The debit of our entry will go to bad debt expense, or BDE as I sometimes abbreviate. Sometimes a customer will pay an amount owed after it was written off. The customer would do as much to maintain good credit, as well as a good working relationship with its vendor. The accounting for this payment is easy and intuitive. First, reverse the write-off entry. Debiting AR puts that amount owed back into receivables. The credit to BDE negates the previously recorded expense. Next, record the collection of cash as usual. This credit to AR takes it back off the books. And the debit to cash records the collection of cash. At this point, you may be wondering that since the debit to AR in the first entry and the credit to AR in the second entry cancel each other out, wouldn't it be more efficient to debit cash and credit bad debt expense? It would, but doing so might cause difficulties later on. Specifically, if there's a variance in an AR account that must later be reconciled, this latter entry wouldn't allow someone else to determine which customer paid late. An ounce of prevention is worth a pound of cure, as the saying goes. So book any such late payments after a write-off via the two entries shown. The direct write-off method's benefits are fairly obvious. Namely, it's simple and intuitive to understand, and easy to apply. That said, it does have a significant drawback. Specifically, its use may violate the matching principle. As an example, imagine a company makes a credit sale in December of a particular year. However, what if the account doesn't become delinquent until a month later in January of year 2? The revenue was recorded in year 1, but the expense wasn't recorded until year 2. For this reason, the direct write-off method is not commonly used. This is not to say that it's never used, but it's popular among very small businesses or those that don't have significant credit sales or AR balances. To uphold the matching principle, most companies opt for the allowance method. The allowance method works via two parts. First, estimate the portion of AR that will not be collected. Second, write off the delinquent AR amounts as they are identified. Say that a company had $10,000 in credit sales during a particular year. That $10,000 debit in AR will be our balance before we apply our entries. At the end of the year, we'll estimate how much of our credit sales do we expect to become delinquent. While this estimate is not pure guesswork, it's based upon experience, it's still an estimate nonetheless. Once we have this amount, we'll book an adjusting entry in which we debit bad debt expense and credit allowance for doubtful accounts. I often abbreviate these accounts as BDE and AFDA for future reference. AFDA is a contra asset account, just like accumulated depreciation. This means that even though it carries a credit balance, it's technically an asset account. Consequently, it will be paired with AR, its parent account, in the balance sheet. By carrying a credit balance, AFDA reduces the value of our assets, specifically AR. Consider that the debit to AR from our credit sales increased our assets, and the credit to AFDA decreases our assets. Were we to build a balance sheet at this point in time, the $10,000 debit balance in AR would be reduced by the $2,000 credit balance in AFDA. The net of these two amounts is referred to as the net realizable value, or NRV for short. In this instance, of the $10,000 gross AR that the company has, it reasonably expects to only collect $8,000 in cash. If it helps, think of AFDA as a holding account for the inevitably delinquent AR accounts. We know we're going to write off some AR amounts, but we don't know which ones. So we're recording BDE and reducing AR with a credit to AFDA right now. When we know who specifically won't be able to pay, we can move that credit in AFDA into that particular customer's AR account. In other words, we'll credit AR off the books and debit not BDE, but AFDA. Observe how the matching principle is upheld. If the write-off of the delinquent AR didn't occur until the subsequent year, it doesn't matter because the revenue and the expense were both recorded in year one, even though our expense was an estimate. Also note that the write-off doesn't reduce overall assets. We already reduced our assets and equity via an expense via the prior year's adjusting entry. The debit to AFDA increases assets, and the credit to AR decreases assets. So there's no net increase or decrease on either side of the equation. We just reshuffle the deck with regards to our assets. We can verify this directly by posting to our ledger accounts. AR drops to a $9,500 debit, and AFDA reduces to a $1,500 credit. If we update our balance sheet with this information, you can see that while the balance is changed, the net realizable value is still $8,000, the very same amount as before our adjusting entry. That's the net impact of write-offs under the allowance method. None. Whoever your instructor is, I can almost guarantee that he or she will ask you on your exam, what is the net effect of writing off an account under the allowance method? Know that the answer will be either none or zero, depending on how the question is worded. How we reverse a write-off under the allowance method is not principally different from how we did so under the direct method. First, reinstate the AR balance by reversing the write-off. Debit AR and credit AFDA back onto the books. Next, collect the cash as you normally would. Just as under the direct write-off method, it's important to book these two entries separately. Doing so allows you or an associate to observe who it was who paid after the fact, should you revisit this journal at some point in the future. Before we proceed, let's make sure we can distinguish between the accounting for bad debts under the direct write-off method versus the allowance method. If you like, you can pause this video and see if you can prepare these entries on your own. On April 1st, we write off an account of B. York in the amount of $3,500. Under the direct method, debit bad debt expense and credit AR for $3,500. Under the allowance method, we still credit AR, but the debit goes to AFDA, not BDE. On June 17th, we receive a $2,200 partial payment of a $5,500 amount owed by Raymond Bradley. The remaining portion of this account receivable was written off. Under the direct write-off method, we still debit BDE and credit AR. AR will be credited for the full amount of $5,500. Ray made a partial payment of $2,200, so we debit cash for the amount received. The amount of our bad debt expense is the difference between the AR removed and the cash received, $3,300. Under the allowance method, the entry is nigh identical, except we swapped bad debt expense with allowance for doubtful accounts. August 22nd. York paid off that $3,500 amount after we wrote it off on April 1st. Under the direct write-off method, first, reverse the original entry by debiting AR back on the books and crediting BDE off the books. Next, record the cash received by debiting cash and crediting AR for $3,500. Effectively, do the same thing with the allowance method. Reverse the original write-off, then record the collection of cash. On November 7th, we wrote off two accounts, Steve Wyman for $1,000 and Lisa Briggs for $3,000. Under the direct method, credit AR off the books for Wyman and Briggs for their respective amounts owed, and debit bad debt expense. Do almost the same thing under the allowance method, but the debit goes to allowance for doubtful accounts. Finally, on December 31st, we estimate that 1.5% of the year's $3.7 million in credit sales will be uncollectible. Under the direct write-off method, we don't do anything. The bad debt expense gets recorded as we remove the delinquent AR amounts. Under the allowance method, debit bad debt expense and credit AFDA for $55,500. We've covered how the AFDA method writes off bad AR accounts. Now let's elaborate on the adjusting entry made. As previously mentioned, at the end of the year, the company needs to make an adjustment, debiting bad debt expense and crediting AFDA for the receivables it thinks won't be collected. How do we determine the amount of this journal entry? Well, we have two methods, the percent of sales method and the percent of receivables method. These methods are sometimes referred to as the income statement approach and the balance sheet approach, respectively. The percent of sales method, or income statement approach, focuses on bad debt expense, which shows up on the income statement. The percent of receivables method, or balance sheet approach, focuses on allowance for doubtful accounts, which shows up on the balance sheet. To explain the percent of sales method, consider a company with the following information. AR has a balance of $1,250,000. AFDA has a $3,500 credit balance. Credit sales for the year amount to $2.5 million. And bad debt as an estimate of credit sales is 0.75%. So what's our adjusting entry? This is one of those problems where the solution is especially simple. You just need to know what to filter out. Take the $2.5 million in credit sales and multiply it by 0.0075 to get the dollar amount of credit sales that we expect we will have to write off. Be careful that you enter 0.0075 when doing this calculation. 0.75 is equal to 75%. 0.0075, that's 0.75%. Credit sales that will be written off is just a fancy way of saying our desired ending balance in bad debt expense. we want bad debt expense to have a balance of $18,750 after we debit BDE and credit AFDA. This is where things get even easier. Like other expense accounts, bad debt expense is a temporary account, meaning it gets closed out to owner's capital every year. Last year, we recorded our adjustment to BDE to build our financials, then zeroed it out. So the beginning balance this year is 0. Consequently, the amount we calculated here is the amount of our journal entry, which gets us to our desired ending balance in bad debt expense. The credit to allowance for doubtful accounts will bring its account balance to a $22,250 credit. How will this flow through to the balance sheet? Our AR balance is $1,250,000 in debits. On the balance sheet, that debit AR balance will be paired with the credit balance in AFDA to yield a net realizable value of $1,227,750. All that said, this information may even be more than you need, because you can simplify the income statement approach by ignoring everything except for credit sales and the percent of sales uncollected. Just multiply those two numbers together, and that's the amount for your journal entry. For the percent of receivables method, bad debt is given as a percent of AR, not credit sales. In this instance, we'll multiply that percentage by the AR balance to arrive at the estimated amount of AR that will not be collected, which is our desired ending balance in AFDA. After all, that's what AFDA effectively is, the estimated amount of uncollectible AR. So, $25,000 is our desired ending balance in AFDA, and AFDA currently has a $3,500 credit balance. That means we need to credit AFDA for $21,500. Consequently, our adjusting journal entry will consist of a $21,500 credit to AFDA and a corresponding debit to bad debt expense. When we post this journal entry to the bad debt expense account, just as in the previous example, it carries a beginning balance of 0. So the amount of the journal entry becomes the balance of bad debt expense. That information is superfluous. The activity of BDE is not pertinent to the percentage of receivables method. Remember that with percentage of receivables, we focus on the balance sheet account of AFDA. To build this section of the balance sheet, we'll take the AR balance of $1,250,000 and net it against the $25,000 credit balance in AFDA to get an NRV of $1,225,000. I would like to elaborate on how that percent of uncollectible AR is determined. Most of your homework questions will just give you a percent of AR, but in practice that amount is calculated using an aging of AR schedule. Here you can observe one such example. It can be read and interpreted as follows. On the far left, you have a list of customers. To the immediate right, you have each customer's amount owed, aka the balance in its individual AR account. The third column is the amount of each customer's AR balance that is not yet overdue. On the right half of the table, you have each customer's amount past due categorized by how long that amount is overdue. For example, Abby & Company currently has an AR balance of $25,000. Of that $25,000, $20,000 is not yet due, but $5,000 is overdue by between 91 to 180 days. Cloud 9 has an AR balance of $30,000. Of that $30,000, $26,500 is not yet due, but $3,500 is overdue by between 1 to 30 days. You can interpret every credit customer's amount owed in this manner. For the days past due table, sum each column to get the total AR owed by length of time. Immediately beneath those totals, we have an estimated percent of them that are uncollectible. Remember from my videos on sales of merchandise, the reason companies often offer a discount for early payment. The longer an amount is overdue, the less likely it will be collected at all. You can observe this phenomenon by these percentages. Of the amounts that are only 1 to 30 days overdue, we can expect 2% of them not to be paid, based upon previous experience. However, once an amount becomes at least 31 days overdue, approximately 5% will not be collected. If an amount goes to 61 days without being paid, approximately 10% will not be collected, and so on and so forth. Multiply the amounts past due by their respective percentages, and we have the amount uncollectible by length of time. Sum up these amounts, and you have the total amount of AR that is uncollectible, also known as the desired ending balance in AFDA. That concludes this video on bad debts. The next video covers receivables and will be the last lecture video of this course. Thank you very much for watching. If my videos are helping and you want to return the favor, you can thumbs up this one. Leave a comment or a question if you have one below. If you really want to help, consider subscribing to my channel. Not forever, just for however long you're taking your accounting course or courses. Finally, share my videos with your fellow classmates and even your professor. I'd like my videos to help as many students as possible, and I wouldn't mind making connections with contemporaries. Thank you once again, and I'll see you in the next one.